All right. My name's Lee Cole. I'm going to be the oddball of this set of presentations. That seems to be my life. I'm not going to be talking about a lot of tools for analytics and classification and the like. I'm going to be talking about what I think is going to be happening in the future, which is this stuff is going to start coming at you a whole lot faster than you think. Michael asked me to do this presentation back in November. I said, sure, not a problem. What I didn't know is that the Harvard Business Review, if you like magazines like that, did an article about it just this month. As a matter of fact, I would love to say that they stole my graphic and they stole my subtitle, but unfortunately I stole theirs. So, if you're interested in a little more detail, the subtitle is the name of their article. Go to hbr.org. If you're a subscriber, this probably is not a group that spends a lot of time on a $100 subscription to Harvard Business Review. Don't worry about it. If you're not, first 5 articles are free. If you go take your browser to incognito mode, you get them all. Don't worry about it. Okay, this is the slide from the HBR article. The point they're trying to make is that right now almost all the investment in data analysis is for historical data, process improvement. If it's moving forward in time, it's very recent time steps. But there's only so much you can deal with that data. There wasn't really that much data long ago. With the Internet of Things, there's more and more data coming up every day. And very shortly, it's going to be economically more feasible to start looking at real-time data than it is historical data. Hasn't happened today, it'll happen soon. A lot of the tools you're seeing presented up here will not work in a real-time environment unless we are fuzzy with the definition of real-time, but in a few years they will, and they will have to. Okay, specific example I'm going to give is securities risk management, okay? It's a 10-minute presentation. I'm going to try and keep it to a few simple points. Securities trading. Who am I? What do I know about this stuff? And how can I talk about it? Background is physics, theoretical physics. Learned computing to do my research. Came to Colorado to manage solar energy research down at what's now NREL in Golden. I've been managing R&D teams ever since. I like it. Makes me weird. In 2005, I was asked to start a small team in Colorado to do risk management software for the securities market. 6 years later, we got acquired by NASDAQ. A few years after that, I left. I have no fancy title. I have no big company to associate myself with. At one point in time, I had a NASDAQ VP title, but we're going to forget about that. Right now, I'm just a geek programmer who tries to have fun, okay? What is high-frequency trading? It is trading. It is not investing. You are not trying to take a position and find out if that stock goes up. What you're trying to do is say, can I buy this right now and sell it a moment later for a profit? Or can I sell it right now and buy it a moment later and still get a profit? The issue with high-frequency trading, quantitative trading in general, is that they normally don't take a position. They don't like holding stocks or holding a short position. What they'll do, ideal world, the ideal example is take 2 stocks, A and B, same industry, roughly the same size company, but over time, the prices are pretty much the same. So if you take A minus B, long-term mean is 0. That's the long-term mean. If they vary a little bit, and one's higher than the other, you take the high one, you sell it. Take the low one, you buy it. If that comes back to the mean, you've made money. The other thing to point out is that those stock prices are here, and they're that far apart. How much money have you invested in that trade? Not the $100, whatever per share, just the difference in the price of those 2 stocks. Quantitative trading started 20, 25 years ago. People started doing this on timescales of 3 months, 6 months, a year, got down to months, weeks, days. Right now, milliseconds, microseconds are coming. We'll talk about timing and performance later. Actually, back here, this thing. All of those stocks, when the market starts, They hope to own those stocks when the market ends. If they hold a stock overnight, they have no idea. What if an oil rig blows up someplace or a war starts someplace? They don't want to take the risk. So, let's go here. What sort of volumes are we talking about? Daily volumes, US listed equities only. You're talking 5 billion market data messages a day. Okay, 5 billion, that's not that bad, right? Unfortunately, roughly 25 to a third of that, 25% to a third of that, happens in the first 20 minutes of the day. Another 25 to a third happens in the last 20 minutes of the day. And it sort of idles during the day. So during the hot parts of the market, you have to be able to process on the order of 1 to 10 messages per microsecond. Okay? Options. Everyone knows what an option is roughly, but most people don't realize options have dates at which they're due and strike prices. All right? So every time the underlying equity changes price, every element in that grid changes price. So instead of having one price change, you've got, say, 10 to order of 100. Foreign exchange is higher, you got futures, commodities, all sorts of things to process in data. Actual trading messages. I have seen a single trader blow through 20 million orders in a day. Each order can be up to 5 messages with the exchange. And for the risk management work F10 was doing, we can talk about it offline if you want, multiply that by a factor of 4, because we basically played a man-in-the-middle attack to approve the trade on risk. The other thing that most people don't realize, 95% of the orders that are placed in the market are canceled. They never actually execute. Just someone's way of finding out what the price is someone willing to trade at that price right now. Short decision time frames. Oh, one thing I should have mentioned in terms of speed. Well, never would go this way. Short decision time frames. Milliseconds at most. There was a book by Michael Lewis out last year talking about that. Milliseconds at most. It's 5 milliseconds from one exchange to the next. That's enough time for people to get in, move something, get back out. Okay? Mistakes can be expensive. I know traders that have $3 or $4 billion worth of positions on the market most of the day and then try to cancel what they don't want in the last 100 milliseconds. And Lord helped them the one day that their system had a pause. And they got stuck with $600 million worth of positions with 10 million in equity. And it was a Friday, so they had to carry that over the weekend. Okay, basically, off-the-shelf tools aren't going to cut it. You need custom code. FPGAs will do the trading protocols. There are some custom ASICs, application-specific integrated circuits. They handle market data. You can buy a trade ticker plant, which is basically custom chips to organize the positions. Competitive pressures. You are not competing against the stock, the company, or the market. You're competing against the next shop. You have to make the decision faster than they do. If you're waiting to get a message out or get a message in, they beat you. You will have missing data. A lot of data comes through, market data comes through as UDP. You will miss some. Some of it will be fat-fingered. Someone will put in the price where they meant the number of shares or vice versa. But that actually closed down a bank in Japan once. Some people are actually going to mislead you. They're going to try and fake you out, make you think the market's going one way when it's going another, so you buy when they want to sell. Network noise, garbage collection times, page swapping, these can all kill you. Databases are too slow. They're not our primary store. Databases are secondary stores. This is what really kills you. That's the shopping cart. It's all queued up at the supermarket, right? Arrival times vary. They're out of your control. I have to speed this up. So, take a ratio of the average time between, denominator is the average time between arrival. Numerator is the average time it takes to service that. Pick that ratio. If you think you can handle 25,000 messages a second, 1 every 400 milliseconds, that's at 100% utilization. If you've ever done any queuing theory, simple queuing theory says that's the sort of curve you're going to get. At this utilization, 50% utilization, you're down here. At 100% utilization, you sky it to infinity. The problem is, this scale isn't quite what you would like. First tick is 20. That means there's 20 messages queued up in front of you. This, zooming down, is more like it. Even at 50% utilization, you always have, on average, one message in front of you. Okay? You have to be fast. You have to be faster than you think. At 25% utilization, you're roughly at a third. 20% utilization, quarter. We always ran our servers at 20% utilization or lower, just for the speed. An idle server can actually respond quickly. A busy server can't. Applies to network and disk I/O as well. How do you pull this off? You focus on algorithms. Your algorithms have to be tight. You do not do objects. You do buffers. We had a market data system written in Java, processed 6 billion messages a day. The only garbage it generated was every 5,000 messages, it did a print line to a file to say what its status was. That was the garbage it generated. It's possible to do it in any language, but you have to be clever. Measure and monitor all the time. I'm not really going to get into cleaning up data, sorry about that. Your data has to be faster. It's going to come on you whether you like it or not. The world's going to move that way. When we have an Internet of Things, the amount of data is going to be huge, and it's all going to be real time. And no one's going to sit there and accept a 3-month-old interpretation of it. Utilization, this is probably the key point. This is what kills a lot of people. They figure they've got it fast enough, and they queue up and they stall, and they lose a whole lot of money. For a different talk, automated strategies for data cleaning, because you do not have the time to do it. You can't go back and ask for missing data. You can't go back and reinterpret anything. You have to handle it live. That's it. Sorry, I'm a little bit over. Thank you.